Ladies and gentlemen, I can understand that there is reason for people to speak to each other during the afternoon. It would be helpful for me as the chair of this meeting if we can progress, and I'm sure at the end there will be a lot of conversation with regard to what the Commissioner did say, and I did say to him we were grateful for him being here and sharing his views. But there are other views that I also want to have shared with you. One of the things that Stephen Hadrill said this morning was in relation to the key role that audit committees have in corporate governance. And we've got to remember that corporate governance, the auditor is only part of that corporate governance system. And audit committees do have a very, very significant part, as do boards of directors. And so we have asked Brendan Nelson to come and address us this afternoon. You can see on the screen that Brendan is a non-executive director and chairman of the audit committee of the Royal Bank of Scotland, and is also a non-executive director and chairman of the audit committee of BP. So not only does he have experience in the financial sector, he has experience in a major conglomerate. And so I would like to welcome Brendan to the podium to share his views with you. Thank you.
Thank you, Mr. Chairman, and good afternoon, ladies and gentlemen. I am delighted to be here today and to speak at this prestigious event, and my thanks to FI for their kind invitation. It is quite a challenge to speak following Commissioner Barnier, and also quite daunting to know that I will be followed later in the day by Mr. Doty. It will probably come as no surprise to most of you in any event that my views are probably going to be somewhat different to the views that you have just heard. As the Chairman has said, I'm here in my capacity as a major user of audit services in my role as Chairman of the Audit Committee of both RBS and BP. And my remarks today will cover two main areas. It is, firstly, matters that are connected with the issue of competition and choice in the listed company audit market, and in particular multinationals, and that's in the light of the EC Green Paper and other recent reports. And secondly, and I think this is a very important aspect, the role of corporate governance, and in particular the role of the Audit Committee in addressing issues or concerns or indeed perceptions regarding the robustness, independence, and hence quality of the external audit process, and as importantly, the Audit Committee's own effectiveness in monitoring it. I must preface my remarks with the usual caveat that these are my views and are not necessarily the views of the organisations on whose boards I sit. And inevitably, my remarks might be seen by some people as having a UK bias. And I do recognise that not all member states are at the same stage of development of corporate governance standards or indeed financial reporting. But, I mean, I do act for two international companies and have a very good understanding of the views of audit committee chairmen of other multinational companies, which are not inconsistent with my own. But firstly, let's look at this issue of competition and choice in the listed company audit market. As Commissioner Barnier said, the financial crisis did raise many issues, but the two that we're most concerned about today do relate to auditors. And there has been a lot of debate on whether the auditors should have spotted or indeed prevented some of the events that everyone else failed to do so. And also many commentators have challenged, albeit with the benefit of hindsight, the effectiveness of corporate governance. And the main issues raised with respect to auditors can, I think, be summarized as follows. Firstly, is there sufficient competition in the audit market, especially for large companies? And secondly, do long-term audit relationships threaten independence and impair audit quality? Now, possible solutions that you've heard today, and also echoed at least in part in other countries, are that somehow or other new entrants should be encouraged into the large corporate audit market, and that mandatory audit firm rotation or mandatory tendering will address independence and audit quality issues. Now, let us be clear that the competition and choice debate is a global issue. And yes, certain large firms have a bigger share in certain markets than others. But on a global basis, the big four firms have a significantly greater footprint in terms of audit market share and geographical coverage than those firms immediately outside of that group. Now, we all know that this situation has arisen due to some intended events, which was the merger of certain firms in the 80s and the early 90s, and some unintended events, which was, of course, the demise of Anderson's. And the big question is whether the dominance of four large audit firms in the listed company market is a problem. Now, let there be no doubt that I share the same objective as Commissioner Barnier, which is to protect the interests of shareholders and other stakeholders of public companies through ensuring the highest quality of external audit. And part of the problem we're dealing with is a lack of transparency over what auditors actually contribute, and also a lack of transparency over how their role is monitored by the audit committee, but more of that later. There is no doubt that there has been a relatively small amount of audit tender activity amongst major corporates in recent years. And this in part underpins the assertion that existing relationships may become too close. And absent a major audit quality issue, auditor reappointment has become almost automatic. Now, I do not disagree that the audit tender market for major corporates has become somewhat stagnant. But let us explore and indeed understand some of the reasons for this. And in my view, it's a combination of at least some or possibly all of the following. I actually believe there has been a lack of proactivity amongst the major audit firms to market audit services absent an audit tender. And this is something quite different from the senior partner occasionally inquiring off the chairman or the chairman of the audit committee of a non-audit client as to whether he's going to put his audit out to tender. And this, in a sense, may have led to, or does lead to, a lack of perceived differentiation in the audit services available. You know, why change if all you're going to get is the same of what you're currently getting? And then associated with this, you get the perceived hassle factor associated with a change and a tender process. But there's also the possible lack of a full choice because of the wide non-audit relationships that a company may have with the other firms. But on a more positive note, another reason why tender activity perhaps has not been as much as people would have expected is that there have been quite noticeable continuous improvements in audit quality over the years. And this is supported, at least in the United Kingdom, by the view of the independent regulator. But another important aspect that has contributed to this lack of audit tender activity has been a lack of interest by stakeholders, and principally shareholders, in who the auditors are, provided that it is a recognized name. And then finally, there's a belief that audit risk increases significantly in the first 2 years of any change, which I have to say is not a view that I necessarily agree with. Now, I believe that a more active tendering market would be desirable, but I'm firmly of the view that this should be market-driven and not imposed by statute or regulation. As far as audit concentration is concerned, more players would indeed be welcomed, but concentration is not the same as lack of competition. Many industries have high levels of concentration, but nevertheless remain highly competitive. My main concern is that the quality of the audit remains high and is seen to be so. So let me therefore share with you some thoughts on mandatory audit firm rotation, retendering, and joint, or what some people refer to as shared or consortia audits. Firstly, mandatory audit firm rotation. The question really is, would a policy of mandatory audit firm rotation enhance audit quality? Would audit firm rotation lead to more independent auditors who would exercise greater professional skepticism? Or does it possibly decrease audit quality in the early years of a changeover as an audit firm takes time to build up its knowledge of the new client? Audit firm rotation is not a silver bullet. Knowledge of the business is crucial to a high-quality audit, but mandatory firm rotation does not necessarily enhance audit quality. Now, several countries, as many of you will know, including Spain and Turkey, had adopted and subsequently dropped mandatory audit firm rotation because it didn't achieve what it was introduced to do. And that effectively leaves Italy as the last man standing, but possibly the catalyst for more countries to follow. Now, additionally, setting aside the quality aspect, there is no guarantee that the audit firm rotation will succeed in providing increased choice in the marketplace. A very likely scenario might be that companies will rotate on a continuous cycle around the Big Four. Now, I'm aware that audit firm rotation has recently been mooted by the PCAOB as a means of helping as a safeguard in relation to auditor independence. However, in reality, in my view, the requirement for rotation of audit engagement partner every 7 years under the ISBA code is already a sufficient safeguard in this respect. And I'm aware that the length of partner rotation period is less in certain jurisdictions. But in additionally, the composition of boards of directors, both at executive level and non-executive level, is not static either. And this also helps to reduce the independence risk that is perceived to exist. Therefore, I don't support this proposal as I don't believe that it will enhance audit quality, nor do I believe that it will necessarily increase the level of choice which currently exists. But I do think the audit risk point associated with change is somewhat overplayed. Let's now move on to retendering. Again, I don't support the setting in stone that a company has to retender its audit every so many years. As I've already mentioned, I would prefer for audit committees to be more transparent in this area by setting out their retendering policy and then reporting via a comply or explain mechanism as to whether they've adhered to this policy. Where in certain circumstances a company deems that it is not an opportune time to put its audit out to tender, then this should be clearly and appropriately explained to stakeholders. Ultimately, I believe that market pressures will force companies to operate within certain retendering periods without the need for regulatory intervention. I also have to caution here that retendering would not necessarily result in a change in the market dynamic, but at least it would provide the opportunity, at least in theory, for non-Big Four firms to tender for the audit and help to ensure that the market was competitive. Let's now turn to joint or shared audits. Now, nowadays, again, as many of you know, this is not commonly used around the globe. 20 years or so ago, joint audits were far more prevalent. However, sometimes things disappear from fashion and then reappear, so we can't merely dismiss the merits of joint audit on this assumption. Now, currently, France requires a joint audit, and South Africa also for its banking institutions. And there are other countries where joint audits still take place on rare occasions on a voluntary basis. And there is, of course, a great debate as to whether joint audit increases or, in fact, decreases audit quality. The 4 Eyes principle of those in favor is contradicted by those who believe it can lead to cracks in the audit and merely increase cost. My own experience is that there is a risk that joint audits can lead to gaps in coverage, albeit a low risk, but they do inevitably increase cost. And similar issues apply to shared audits, with one audit firm reporting at a group level, but another responsible for a part of the group. And also 2 audit firms working alongside each other could lead to a less open relationship between the auditor and the audit committee, given the territorial concerns of the partners involved from the competing firms. Now, I actually believe that a more active audit market can be achieved by firstly firms being more proactive in the promotion of their audit services, secondly key stakeholders, and in a sense principally institutional investors, taking a keener interest in audit appointments, thirdly more disclosure in annual financial statements on the date auditors were first appointed, and finally companies establishing and disclosing a policy that requires that the audit relationship is formally considered for retendering at given intervals with a comply or explain approach. Now, I also believe that two related issues should also be addressed. The first is the level of assurance provided on corporate reporting, and also the issue around the level of transparency on the effectiveness of the audit process. Now, it's not within my remarks today to broaden the debate on the level of assurance provided on corporate financial reporting, but let me just say that there's been a dramatic increase in additional financial information provided by companies beyond what is commonly known as the statutory accounts. Audit has firmly remained rooted in statutory accounts and has not really changed in line with corporate reporting, and this, in my view, needs to be examined. But let me now turn to the second part of my remarks regarding the role of corporate governance, and specifically the role of the Audit Committee. And here I will deal with the transparency issue that I referred to earlier. It is clear from the EC Green Paper on audit policy that there is some skepticism amongst the European Commission as to the merits or otherwise of the role of the Audit Committee. Now, I do not share that skepticism, and was recently the co-signatory to a letter to the European Commission, along with the Audit Committee chairman of some of the leading public companies in Europe and North America, representing over 850 billion euros of market capitalization and some 2.5 million employees, which highlighted the importance of the role of non-executive directors, and in particular the role of the Audit Committee. There has been a dramatic evolution in the effectiveness of company boards of directors in the past 10 years. Much of this was driven by the reaction to the Enron collapse, which included the revised 8th Directive on Statutory Audit, as well as ongoing improvements to the corporate governance codes in member states, but also as a consequence of economic reality. Boards have met more frequently and for longer hours, and they have engaged more deeply on the issues challenging their respective companies. And in addition to what typically was an average 8 to 10 board meetings a year, it's now turned out to be many more. And non-executives have taken it upon themselves to meet more frequently with members of management and with internal and external auditors, both formally and just as importantly informally, in order to gain insight into management effectiveness and provide guidance. Today, board committees are more active, delving deeper into key issues, such as accurate financial reporting, executive remuneration, and board composition. And they also undertake evaluations of board performance to understand where improvements and oversight can be made. As you know, non-executive directors are elected by company shareholders to represent their collective interests by providing oversight of company management. And as such, it is their responsibility to make decisions in the best interest of all company shareholders and to hold management accountable. If shareholders object to the way non-executives carry out their responsibilities, then they can remove them from the board. Non-executives do take their responsibilities very seriously, and I believe can help the Commission achieve many of the objectives by doing so. But as with anything, there is always room for improvement, and the role of the Audit Committee is no exception. Given the expectation gap that has come to exist amongst stakeholders regarding the role and functioning of the audit, I do support several considerations put forward by the Commission and other stakeholders. Firstly, a more comprehensive auditors or audit committee report that would provide more information regarding the work involved in the audit. Now, I personally favour this being the responsibility of the Audit Committee, and such a report should go beyond routine housekeeping information and provide greater insight into the actual work of the committee during the year, and some indication of how it spent its time, what issues it focused on, would provide more colour to an otherwise pretty monochrome report. It is also important for the Audit Committee to explain how they evaluated the effectiveness of the external audit process. And this could include assessing the experience and expertise of the senior members of the team, the scope of the audit work planned and executed, the quality of the dialogue between the external auditors, the Audit Committee, and senior management, the clarity, quality, and indeed robustness of written reports presented to the committee by the external auditors, and finally, the views of management on the performance of the external auditors. Now, there have been significant improvements in Audit Committee reporting in recent years, and Barclays in the UK, in my view, is a very good example. And I would urge companies and regulators to define best practice in this regard, to provide consistency across companies and indeed across geographies. My second point is enhanced reporting from the external auditor to the Audit Committee to provide more detail and to point out issues that the Audit Committee should raise with management. There is no established benchmark standard for external auditor reporting to the Audit Committee. This has evolved through a combination of the audit firm's own initiatives and the demands and expectations of their clients. And there is some work taking place in the UK to provide some benchmark guidance, which I welcome. Concern has also been expressed about the potential lack of auditor skepticism. Now, I have to say this is not something that I have experienced either as a provider of audit services or more recently as a user of audit services. And I think part of the problem is a lack of transparency and, again, possible misunderstanding of how the audit process actually works. Auditing is an interactive and, in a sense, consensual process. Most companies would discuss highly judgmental issues with their auditors before determining their position. So, in a sense, neither party begins with a definitive position that has to be reconciled in some way with the other. Nevertheless, the clear indication of the level of prudence adopted by the company in judgmental areas should be a standard component of such a report, together with an indication of areas where the auditor has had to push a company towards a more acceptable position. And although the role of the Audit Committee was not addressed in the Green Papers on corporate governance or audit policy, I do believe it's critical that the Commission more clearly articulate the responsibility of the Independent Audit Committee to select, remunerate, and assess the performance of the external auditor beyond what is outlined in the 8th Company Law Directive. And I was glad to see the report from the European Parliament was positive in relation to the role of the Audit Committee plays in a proper system of corporate governance. So in conclusion, I'm not of the view that there is a major issue with audit quality as a result of market concentration or longevity of relationships. Nevertheless, I would recommend that we explore ways of stimulating more activity in the audit tender market without having to resort to mandatory auditor rotation or mandatory audit tendering. And I also believe that a review is needed to address the expectation gap between the current scope of external auditor activity and market perception and possible expectations. And finally, more transparency needs to be given to the role of the Audit Committee, as I actually believe that in most cases they're doing a much better job than they're being given credit for. And I am confident that the Audit Committee chairs of the EU and the US would be happy to meet with Commissioner Barnier and indeed Mr. Doty to discuss these issues. In my view, constructive dialogue is essential to ensure that we do not introduce measures which may have unintended consequences. Thank you for your attention. I'll be happy to answer some questions.
Well, thank you very much, Brendan, for your thoughts on the role and responsibilities of the Audit Committee. We did intend to have a question and answer session after each of the keynote speakers. Brendan used the time allocated perfectly to give his ideas, but in the interest of time, and the fact that we do have a panel and a keynote speaker, I would like to move on to the next panel. So I do apologize to those who have burning questions that they would like to ask for Brendan Nelson. But I would like to thank him for his contribution to this, and I would welcome Giacomo Bugna to lead as the moderator of our next panel. Thank you.